Now speaking, Anant Krishnan, Vice President, Corporate Development and Strategy. Good afternoon, everyone. Today, we will be discussing Aurora's fiscal 2024 first quarter financial results. You can find the details in our news release, financial statements, and MD&A, which are available on our IR website, SEDAR, and EDGAR. We also have a supplemental information deck on our IR website. I want to remind you that some of the matters we discuss today may be forward-looking statements, and actual results may differ from our expectations. You can find the risks and risk factors in our annual information form and other periodic filings and registration statements, which are accessible via SEDAR and EDGAR. Now, I will hand it over to our CEO, Miguel, to provide his remarks. Now speaking, Miguel Martin, Chief Executive Officer. Aurora is a leading global cannabis company and a top plant propagator. We just delivered a record-breaking quarter with the highest revenue and adjusted gross profit in 3 years. We are focused on generating free cash flow and have made significant progress in our transformation over the past 3 years. Our next-generation cultivars are producing higher potency and greater yields at a lower cost. We have reduced SG&A expenses by 50% while investing in talent and expertise. We are leaders in the medical cannabis market in Canada and globally, with a strong presence in Germany, Poland, the UK, and Australia. We are diversifying our revenue by entering the plant propagation industry, which offers long-term value and growth opportunities. Our controlling interest in Bevo is expected to provide free cash flow growth and exposure to critical infrastructure assets. We see potential for Bevo to double its revenue and cash flow through the orchid business. We are also expanding with Aurora Sun, a 1.6 million square foot greenhouse in southern Alberta. We have significantly reduced our convertible debt and prioritized fiscal management and cash flow. We plan to introduce 75 new products to the Canadian market and expand our international channels. Our Canadian adult use business is moving towards profitability, and our medical business is benefiting from a broad product assortment and excellent patient experience. We have strong demand for our products in Europe and Australia and are well positioned to capture market share. We have a strong regulatory team in Europe and are supportive of potential positive changes in Germany and France. Our cultivation science and efficient facilities are driving down costs, and we are on track to achieve $40 million in annual savings. We are confident in generating positive free cash flow in 2024. It's an exciting time for Aurora, our shareholders, and our employees. Now speaking, Glenn Ibbott, Chief Financial Officer. Aurora had a strong Q1, with net revenue of $75.1 million, up from $50.1 million last year. Our international medical business is growing rapidly, and Canadian medical had another solid quarter. Consumer business was up year over year, despite the halt in our Glitches product. Bevo had its best quarter ever. We achieved the highest adjusted gross profit in 3 years and delivered our third consecutive quarter of positive adjusted EBITDA at $2.2 million. Our medical cannabis business represented 75% of Q1 cannabis revenue and 88% of adjusted cannabis gross profit. Consumer cannabis net revenue was $13.2 million, up 5% from last year. Bevo contributed $19.9 million in net revenue, an 85% increase sequentially. We expect Q2 cannabis net revenue to be similar to Q1, with a slightly higher focus on international medical. We are on track to achieve positive free cash flow in 2024. We closed less efficient operations and made cost reduction initiatives, which will positively impact cash flows and margins. We have approximately $63 million of convertible debt remaining, which will be settled within the next 7 months. We have approximately $214 million of cash and cash equivalents. Overall, Aurora's financial metrics have improved over the last 3 years, and we are well positioned for growth opportunities. Now speaking, Miguel Martin, Chief Executive Officer. We've achieved positive adjusted EBITDA for 3 consecutive quarters and set a company record in Q1. Our focus on global medical cannabis has set us apart in the industry, with strong gross margins and leading market share positions in Canada, Europe, and Australia. We continue to innovate and develop quality products for our loyal patient base. The acquisition of Bevo adds a complementary growth channel to our business. We are also implementing significant cost reduction measures, targeting a further $40 million in cost savings by fiscal 2024. Our strong balance sheet allows us to be opportunistic in a rapidly evolving industry. We have the capital, plan, and staying power to create value for our shareholders. Thank you for your interest in Aurora. Operator, please open the lines for questions. TD Cowen analyst Robin Holby inquired, can you provide more details on the growth in Australia and its impact on the overall international medical cannabis segment gross margin? Miguel Martin replied, the Australian medical business is estimated to be around $400 million in annual manufacturer revenue, similar in size to the Canadian market. Our partner, Med Relief Australia, has a strong sales organization and we see the Australian market growing rapidly. While the market currently lacks certain common formats like pre-rolls and extracts, we are excited about its potential. As for margins, they are slightly lower in Australia compared to our fully integrated operations in other European markets like Germany and Poland. Glenn can provide more specific details on this. Glenn Ibbott replied, as we expand our international sales and incorporate more Australian revenue, it is possible that our percentage gross margin may decrease. However, it is crucial to note that this represents additional gross margin dollars for our company. This growth aligns with the global expansion of the medical cannabis industry. Miguel Martin replied, our company recognizes the importance of EU GMP certification in the market. It serves as a key differentiator, showcasing not only the high quality of our products but also our ability to meet and exceed this standard. We are proud to have a substantial amount of EU GMP production in our Canadian facilities, which allows us to leverage synergies and efficiencies when shipping to countries like Germany, Poland, and Australia. This strategic advantage positions us well in these markets. Piper Sandler analyst Michael Lavery inquired, can you provide an estimate of the expected improvement in margins for medical cannabis throughout the year? Is this improvement separate from the cost savings identified, or is it primarily driven by the $40 million in savings? Miguel Martin replied, yes, the transition of servicing the European market from our Canadian facilities will have a significant positive impact on our margins. Previously, these markets were being serviced by our Nordic facility. By servicing these products from Canada, we expect to see a substantial improvement in margins. Jen will provide further details on the timing and scale of this transition. Glenn Ibbott replied, as we bring cultivation back to Canada, we are efficient producers and launching new cultivars that drive higher yields and cost efficiency. This will positively impact our margins. We are also seeing the newer cultivars gaining traction in Australia. Additionally, we have made changes in sourcing flower and allocating resources, which will drive international margins up throughout the year. While the magnitude is yet to be determined, we expect to see the full impact of sourcing from Canada in Q3 and Q4, which could potentially increase margins by at least 10 points. Piper Sandler analyst Michael Lavery inquired, can you provide a comparison of Bevo's year-ago revenues to this quarter, even if it was from the prior owners? Glenn Ibbott replied, our press release indicated a planned increase in propagation revenue of approximately 12% to 14% compared to the previous year. This growth is based on an apples-to-apples comparison, considering the revenue of the acquired company at around $40 million when we purchased it. Currently, their revenue has surpassed the high 40s mark. Looking ahead, you can model the next couple of quarters with the expectation that typically 25% to 35% of annual revenue will be realized during this period. Our current run rate falls within the range of $45 million to $50 million. ATB Capital Markets analyst Eric Lifshitz inquired, can you confirm if the target for adjusted SG&A spend moving forward is still below $30 million, and provide some insight into how you are planning to manage SG&A spend going forward? Miguel Martin replied, when it comes to our SG&A, selling, general, and administrative expenses, we have observed some interesting trends. Despite achieving significant efficiencies in our cultivars, resulting in up to 2x higher yields per square meter, we have not experienced a substantial increase in SG&A costs. This means that we are able to grow our top line and improve our margins without a significant impact on our overall SG&A expenses. We believe that keeping our SG&A below 30% is the right approach. Additionally, we are making substantial investments in R&D, science, and innovation, while also expanding into new markets such as Switzerland and Austria, all within the same SG&A framework. This demonstrates our ability to achieve growth in our top line while maintaining efficiency. Glenn, perhaps you can provide further insights on this topic for Eric. Glenn Ibbott replied, our strategy is to reduce SG&A to a stable level that supports business growth. We aim to achieve scale and leverage from this base. Some SG&A is driven by revenue and volumes, such as sales commissions. However, a significant portion of our SG&A is fixed due to being a U.S.-listed public company. We still have a few $1 million to cut, and our objective is to keep it below $30 million. We have outlined cost savings that will further reduce SG&A over the next year. These savings will start to show up in the next couple of quarters. Canaccord Genuity analyst Yun Kang inquired, can you provide insight on the potential impact of the recent media reports about the Greens Party's efforts to legalize recreational cannabis in Australia? Additionally, could you discuss any potential opportunities for growth in the recreational market, particularly in collaboration with Med Relief or other avenues? Miguel Martin replied, in Australia, we have a strong relationship with the regulatory authority, the TGA, and elected officials. While there have been headlines about the Green Party and recreational cannabis, it is not currently actionable. The regulatory agencies and validation processes in Australia are similar to those in Canada and other markets, giving us an advantage with our focus on excellence in the medical market. We believe there is still upside for the overall size of the medical market in Australia, with the potential for new formats like extracts, edibles, and pre-rolls to have a significant impact on the patient base. Changes to laws regarding cannabis and driving, as well as an expansion in the reimbursement model, could further open up the market. In Australia, the top 3 companies, including MedRelief, represent over half of the total business, indicating a consolidated market. CIBC World Markets analyst John Zamparo inquired, "Can you discuss the sustainability of growth in Australia's market and what factors differentiate it from the saturated Israeli market a few years ago? Specifically, what keeps the top 3 providers in Australia at the top and are there any barriers to entry?" Miguel Martin replied, "In comparing Israel and Australia, there are a few key differences to consider. Firstly, Australia has a larger population and patient base, which means a potentially bigger market opportunity. Secondly, the regulatory process in Israel was more fluid, with starts and stops in determining import and testing criteria. In contrast, Australia's Therapeutic Goods Administration, TGA, has established common standards that align with EU GMP. Additionally, the majority of the cannabis business in Australia currently relies on imported flower, unlike Israel where locally grown flower plays a larger role. While we have been supportive of Israel and have a strong presence in Australia, we are more optimistic about the Australian market due to its larger revenue potential, standardized regulations, and current market dynamics. However, it's important to note that the cannabis industry is dynamic, and we have demonstrated our ability to adapt and succeed in various markets. We have established leadership positions in Germany, Poland, Czech Republic, and are expanding into Switzerland and Austria. As opportunities arise, we remain focused on capitalizing on them. Currently, Australia presents a great market for high-quality flower, which explains the market concentration we are seeing. CIBC World Markets analyst John Zamparo inquired, "What is your view on the court ruling on chewable extracts and Health Canada's position?" Miguel Martin replied, "The recent ruling regarding the stay on a specific product has been an interesting development. The decision has been sent back to Health Canada to explore potential opportunities in the listing process. While we are not critical of Health Canada, we appreciate the progress Canada has made in the cannabis market and the predictability of the process. Although this ruling may benefit another company, we remain optimistic and look forward to collaborating with Health Canada. We actively engage with industry groups to stay informed as the overall progress continues, particularly regarding the 10 mg limit and the designation of ingestible extract, which we believe is crucial for licensed producers to tap into this significant market." Miguel Martin replied, "We are indeed pleased with our performance this quarter. Our team at Aurora has demonstrated exceptional dedication and expertise across all our business segments. We appreciate your continued interest in our company and the industry as a whole. We remain optimistic about the exciting opportunities ahead and look forward to keeping you updated on our progress. Thank you once again and have a wonderful evening."